Alright, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today we're going to be talking about dividend stocks. Specifically, we're going to be talking about the best dividend stocks for 2019. And the reason why I think we should all consider owning a few dividend stocks is very simple. And the reason being is because these are companies that you can buy, leave it, let it grow, let it pay you dividends, reinvest your dividends, then these dividends keep on growing and then pay their own dividends. And 30 to 40 years later, you've got a compounding machine that's worth quite a lot more than what it was when you bought it 30, 40 years ago. And as long as they continue to run their business in a smart way, continue to be profitable, continue to grow their dividends and profits, you'll have a very nice passive income generating machine by the time you get to that age when you might be considering retirement. So I think that, it's a good idea to consider some of these stocks. So guys, let's get into it. So before we get into the actual companies, what I wanted to do is just to talk you through what I believe are some of the important criteria that one should consider when looking for a potential long-term buy and hold dividend company. And the first criteria is that it should have good, solid free cash flows. And the reason being is because if the company does not have good, solid free cash flows, then they cannot pay you a dividend. Okay, it's pretty simple. If the company's broke and it's always cash flow negative, it never has any cash to pay you. The second criteria, again, very simple, is that it should be growing sustainably and steadily over time. Okay, so we don't want any companies that go like this one year and then like that one year. What we want is a company that is proven and will continue to slowly grow their their cash flows, their earnings, and whatnot over time, so that you can then benefit from that growth as they pay you a little bit more each year over the coming 10, 20, 30 years. And the third criteria is that it has to be a very low maintenance company. And what I mean by that is, this company should ideally be quite a boring company that isn't too flashy, and ideally it should be a very predictable business where, as sure as you are that the sun's going to come up tomorrow and then set tomorrow, you can be sure that people will continue using the services or the products of the company that you've invested in, and it'll continue to grow with inflation, and it'll also continue to be in demand and serve the market that they serve indefinitely, right? So that's what I mean by low maintenance, is a company that you can, it's like these two old married people, right? Very boring, very predictable, not exciting, but very reliable, and that's what you want. And the final most important criteria, as Peter Lynch would put it, is that the company has to be easy to understand. And what I mean by that is that you should know why people will want to use this product or service and continue to use this product and service moving forward indefinitely. And so he puts it very, very simply over here.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks.
Okay, guys, so let's cover the first company, okay? So Archer-Daniels-Midland. You probably haven't heard of this company before, but the reason why I think this is a very reliable, boring company is very simple. So let's have a quick look at what they do, okay? And upon initially looking at this page, you guys might be thinking, well, this is crazy. I thought you said you have to understand this business. I mean, what the hell is xanthan gum, and what the hell is adhesive agents and crystalline fructose? And, I don't understand this. And so to that, I say, go to your nearest supermarket, whatever country you're in, go to any aisle, pick up a packet of anything, and read the back and look at how much of this crap, these weird ingredients are in these foods, okay? And most people don't even realize. And the reason being is because these food ingredients will make up the majority of foods that you see in supermarket, because everything is becoming more processed and companies all want to make more profit, and as a result they want to make these things last longer in the shelf life or taste better or have a better color. For whatever reason, they're going to use these food ingredients, and that's why I think Archer-Daniels and Midlands will continue to grow. People will continue to eat. People will eat more processed stuff because they're busy, and these food ingredients will, as the population grows, will only continue to grow with the population. Okay, so that's the reason why I like this company. And so, as you guys can see, pretty solid balance sheet. Low level of debt, a good amount of available liquidity to continue to maintain the business and continue paying dividends, and a solid track record of slowly but surely compounding and increasing dividends bit by bit by bit, year on year on year. Okay, and this is what you want. And so, and as you can see, the dividends really aren't at a risk of potentially being cut, and the reason being is because the payout ratio is still very, very low, and they've got a lot of room available to either increase dividends or continue paying dividends or whatever. So it's going to be very reliable, very predictable business. And as you can see, a track record of 25 years of growing dividends and currently paying at about a payout ratio of 30% with a 5-year growth rate of about 12%. So that's actually not bad, right? So if they continue to pay dividends, 20, 30 years from now, I think you're going to have a very good time. Okay, next company needs no introduction. Ronald McDonald. Okay, good old McDonald's. We all know it. We've all probably eaten there. We probably might even eat there this week. Who knows? And the reason why I like McDonald's is because, again, if we think back to the criteria that we covered at the beginning, it meets pretty much all of those criteria, right? And it's one of very few companies that didn't actually go down that much, if at all, in the recession, because people are still going to eat cheap, quick food. And so as a result, their profits and their revenue continue to sort of grow even during that time, which is reflected by the stock price. And as you guys can see, so they're still making a good amount of profit. But what's really interesting is if we look at the first highlighted line, you'll see that they've started to have less companies that they own directly and started to franchise everything out. And so as a result, their profits are growing more and more, and the reason being is because this is a much more profitable model for them. And I think moving forward into the future, the majority of McDonald's stores will actually be franchised, right? So they're still paying good dividends, it's growing, and many McDonald's stores, the most popular fast food brand in the world, and as you can see, year on year on year on year, they have more and more stores popping up in pretty much every location you can think of around the world. And so as a result, they've been growing their dividends for 42 years. Again, not at a crazy ratio, but, nice, steady 6% growth, 6% 5-year growth rate, paying out at just under 60% of their profits and cash flows. So again, plenty of room to continue increasing these dividends without too much, stress to the company. Okay, guys, so next, CDL Investments Limited. Okay, so this is a New Zealand company, and this is actually my favorite dividend stock out of all of these stocks, and one of my largest holdings. And the reason why I like this company is it's very simple, okay? It's a property developer in New Zealand targeting the middle class, okay? You've got lower middle class, upper middle class, and middle class. And these are the working classes with families who need houses, who have a good income, who can service these houses, and this will be, I believe, one of the largest growing population demographics in all of New Zealand. And you guys might be thinking, okay, well, there's plenty of property developers, okay, why do you like CDL? Like, what's so special about these guys? And the answer to your question is very simple. And so if we look at their group equity and their net asset backing per share, and then you actually have a look at the market cap and the share price, and if we pay careful attention to these two things, you'll realize that by buying into CDL, you're effectively buying it at less than book, okay? And so when you look at a company that has been continually growing their earnings and their cash flows year on year, increasing their dividends and only paying out at a ratio of less than 30%, and then you look at their net asset backing per share, the company has been priced like it's going to die, but yet when you buy this company, you get more in assets than what you paid. And so it just seems like a very, very good deal to me, right? And so the other thing that I really like about the company is they have no long-term debt. Okay, so they are not at the mercy of any interest rates or repayments or anything along the lines of that. They've got no long-term debt, very little short-term liabilities, lots of net assets, and as you guys can see, a lot of cash on hand. So if you bought CDI today, you're effectively getting about a quarter of your money in cash, along with all of their assets. So to me, this just seems like a crazy, crazy good deal. Okay, so they've been debt free, and they do all their property development with cash. Okay, so everything that they do, the land that they buy, cash. The stuff they use to develop these properties, cash. It's all cash. So no interest payments, and just a very, very healthy company. And if you guys are a fan of Seth Klarman, you'll know that this is a massive margin of safety. And yeah, I think this company will do well on the long term. And if we pay careful attention to their balance sheet, you'll realize that their book value, all of their property assets, they actually recorded at carrying value and not market value. So if you actually look at the market value of all their assets, you're effectively buying this company today for about 0.4, 0.5 times book. Okay, so lots of cash on hand, very, very undervalued, good margin of safety, no debt, steadily paying dividends for the last 10 years. Now, CDI have actually been paying dividends consistently. There was a moment where the dividends dropped to zero due to the GFC, but as you can see, the year after that, they quickly resumed paying dividends and have continued to grow it over time. All right, guys, next company. Again, needs no introduction. Coca-Cola, Coke, whatever. Most valuable soft drink brand in the world. Much like McDonald's, people will continue to drink it. It's very popular. It's pretty much available in every single country. They also not just have Coke, but they have a whole ecosystem of drinks, right? Because now that people are getting into healthy things, they've started getting into teas and sparkling waters and whatnot. So great ecosystem, massive distribution network, which allows them to pretty much dominate in terms of pricing structure and their relationships with the people that sell their drinks. Okay, so as you guys can see, huge network, and in fact, the likes of a Monster Energy, they've actually had to basically do work with Coke in order to leverage that scale. So when you buy Coca-Cola, you're not actually just buying the drink company, but you're actually buying the relationships, the ecosystem, the large distribution and logistics network, unrivaled, which allows Coca-Cola to really, dictate in terms of pricing. Because it really, you can almost call it a monopoly, right? Because Pepsi is nowhere even near them. And so as a result, they've got a huge ecosystem, and they actually own, you'll be surprised at how many things they own. So the brand up here in the top left corner, Coca-Cola Amatil, that's the Australian New Zealand version of Coke. And in Australia and New Zealand, they actually own the likes of Jim Beam, right? And then you've got Powerade, which is effectively the Australian New Zealand version of Gatorade. So massive ecosystem, lots of products. This company is just going to dominate. And again, as you guys can see, steadily paying and growing their dividends for the last 56 years. Nice, stable, steady payout ratio. Nice, stable, steady dividend growth rate. Payout ratio is a little bit high. So this is I guess it's not a huge red flag because people will still continue to drink Coke and all of this other stuff. But, not my favorite of these five, but still a solid company. Okay, guys, and finally, we've got Invesco. Okay, and the reason why I've put Invesco in here is very simple. I think it's one of the most popular companies that offer things like ETFs and different funds. You probably have or know somebody that invests passively through one of their options. So they operate some of the most popular passive investment or ETF options around the world, and they've got pretty much something for everybody. Ever since the market crashed back in 2008, 2009, ETF investing has become more and more and more popular, right? Because ETF investing has been around for some time, but it didn't really take off until the entire market crashed and made a massive rebound. And as a result, millennials who, either have only lived through one market crash or hasn't seen the previous market crashes, they just think if I put my money blindly into a bunch of funds, it's going to go up. And as a result, the likes of Invesco are getting more and more popular, offering this fund and that fund and another fund, right? And the good thing about this is that because ETFs are going to continue to gain in popularity, the majority of investors won't actually be picking their own shares. They're going to be just putting it passively into an index fund, which means lots of business for Invesco. And not only that, but fund managers are finding it harder and harder to outperform the index. In fact, over a 10-year period, as you guys can see here, the good majority of hedge funds actually underperform the index. So then you've got investors going, well, why should I pick my own stocks if I can't outperform? And then why should I give it to a hedge fund if they can't outperform? I might as well just go to the likes of an Invesco, buy an ETF, track the market, and if it goes down, I go down with the market. If it goes up, I go up with the market. Seems like a good deal to me, right? And so as a result, these ETFs and passive investing, because it's growing in popularity, I think that it's going to be continue to grow in popularity over the long term. And I think it's going to be a reliable, predictable source of income for the likes of an Invesco. It's been paying and growing their dividends for the last 10 years. Good payout ratio of about 50%. Nice, solid, predictable growth of about 7% in terms of the dividend growth rate over the 5 years, and a very, very high yield of about 6%. So all in all, I think it's a solid company, and people will continue to pump their money into passive investing going forward. And so I think over the long term, this company is going to do well. Okay, guys, so that concludes the video. I hope you enjoyed watching it, and just a reminder, none of what you see on this video or channel should be considered as financial advice, and you should always do your own research before investing. So if you guys enjoyed the video, remember to leave a like, drop a comment, subscribe, and share the video, and I'll catch you next time. Until then, happy investing.